Today I'm going to get into the forecast or projections for the stock market for the year 2023. I try to stay away from projections because I just do. So I'm going to play some clips from two people who I respect a lot, Mike Wilson from Morgan Stanley and Mohamed El-Erian, and let you see their thoughts. I happen to agree with Mike Wilson and to an extent Dr. El-Erian as well. And I just think they're very well-respected people who've had a very good track record. Hi, I'm Ben Reppond. Today is January 31, 2023. Welcome to my YouTube broadcast. First, I'll start with Mike Wilson, who was interviewed by CNBC's Scott Wapner. Who is Mike Wilson? He is the Chief U.S. Equity Strategist and Chief Investment Officer for Morgan Stanley. He was also voted the #1 market strategist in 2022 Institutional Investor Survey. In other words, his peers think he is the best among them in determining the direction of the market. That is quite a lofty title and a lofty accomplishment. Let me say up front that I completely agree with Mike Wilson for the reasons he states. He believes that the market has to go down from here before it can go up in a more prolonged manner. The rally in January is what I call a head fake. We saw plenty of those in 2022. There is one simple reason. We are still in a bear market, and the market wants to go in a downward direction. Any attempt to go up will be met with resistance as long as we are in a bear market. That is how bear markets work. When we had a pullback in January, we got fractionally in the market. We got 50% of the market in the strongest index. We are prepared to leave that position if the market goes down or add to it when we get the opportunity to buy at a better price. Right now, the market is being driven by small investors and small retail investors and operating on emotion. The fear of missing out. So I'll let you listen to what Mike Wilson has to say, and then I'll add some comments.
I'm good, thanks. I hope you heard our conversation, mine with Joe Terranova a short time ago, where he suggested that the market is in a better place. We are in a better place, is what he said. I said you were going to take issue with that. Is that true?
Yeah, look, I think, some businesses are in a better place because they've taken the medicine and they're set up for, tougher times. As Joe rightly pointed out, good CEOs are acknowledging that. That's what they should be doing. However, those tougher times we think are going to get a lot tougher. And what we're talking about specifically is margin and profitability. So we're seeing it in the numbers. I mean, this has been our call, as you know, for the last 9 months. So I would say 9 months ago, that call was up for question. It's unequivocal now, Scott. I mean, you talk about it on your program all day. I mean, the operating leverage is going in the wrong direction. I mean, Texas Instruments is another good example where the operating profit, missed on a margin basis and also on a dollar basis. And we're seeing that all across the economy today with, Union Pacific specifically cited that. They talked about operational inefficiency. It's a theme we've had all year. And we think that theme is only about halfway baked. And it's all wrapped around this idea around inflation, which is confusing, right? We haven't had inflation like this in, any of our careers, really. And so what's happening is inflation now is coming down, but costs are sticky. And it's the opposite of what we saw in 2021. And we just think that people are underestimating the magnitude of this negative operating leverage cycle, which is made worse by inflation coming down faster than expected.
Hasn't the market already adjusted, though, to all that you just suggest is still to hit it? I mean, we absorbed a pretty good body blow on the fact of what the Fed was embarking on and the impact that all of that hiking would have.
Yeah, look, I mean, I think the market has absolutely digested the Fed. And we talked about that back in October. That's why we went tactically bullish, as you know, when we were trading at 3,500 and we were trading at 15 times earnings. We felt like that was actually a decent pitch. It worked. Liquidity was better at that point too. But now we're at 17.6 times earnings again, Scott. And now the numbers are actually going to finally come down in a way that we didn't think would happen in Q4, which it didn't. But now we think that's happening. So we would argue against what Joe was saying. We think the market's in a worse shape because the equity risk premium is lower today, which means the market's not worried about risk. It's still focused on the Fed, which it should be, because the Fed's not going to be cutting rates anytime soon. But remember, rates are lower. We already had the multiple expansion from that. So unless you think rates are going to drop here precipitously because we don't have a recession, that seems unlikely, then it's hard to argue for higher multiples to offset any earnings degradation.
Would you admit that the economy is stronger at this point in the hiking cycle than you thought it would be?
Oh, I mean, that is actually a very good question, Scott. I mean, a year ago, as you know, we were talking about the Fed was going to have to go harder. If you had told me the Fed would be able to raise 450 basis points on their way to 500, and we wouldn't already be seeing, labor cycle, a more dramatic labor cycle, a hard landing, I'd be surprised. So yes, I have been surprised at the resilience, but that just speaks to the incredible savings that was built up. The stimulus has lasted longer than perhaps we thought it could. But the Fed has recognized that, right? And so they've gone harder and they've gone higher than anybody expected over a year ago. And that's going to have lasting impact into 2023. I'm
going to play another clip from Mike Wilson. And this is so important for investors that I want you to listen carefully to what he is saying. This one is put out by Morgan Stanley rather than a CNBC interview. He emphasizes the same points with a bit more clarity. This is about 3 minutes, but it is a very important 3 minutes if you're an investor.
Welcome to Thoughts on the Market. I'm Mike Wilson, Chief Investment Officer and Chief U.S. Equity Strategist for Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, I'll be talking about the latest trends in the financial marketplace. It's Monday, January 23rd at 11 a.m. in New York. So let's get after it. Coming into this year, the number one investor concern was that everyone seemed to have the same outlook for U.S. equities, a tough first half followed by a strong finish. Views varied on the degree of the drawdown expected and magnitude of the rebound, but a majority expected a U.S. recession to begin sooner rather than later. Fast forward just a few weeks and the consensus view has shifted materially, particularly as it relates to the recession view. More specifically, while more investors are starting to entertain a soft landing for the economy, many others have pushed out the timing of a recession to the second half of the year. This change is due in part to China's reopening gaining steam and the sharp decline in European natural gas prices. While these are valid considerations for investors to modify their views, we think the price action has been the main influence. The rally this year has been led by low-quality and heavily shorted stocks. It's also witnessed a strong move in cyclical stocks relative to defensive ones. This cyclical rotation in particular is convincing investors they are missing the bottom and they must reposition. Truth be told, it has been a powerful shift, but we also recognize that bear markets have a way of fooling everyone before they're done. The final stages of the bear are always the trickiest. In bear markets like last year, when just about everyone loses money, investors lose confidence. They question their process as the price action and cross currents in the data create a hall of mirrors. This hall of mirrors only increases the confusion. This is exactly the time one must trust their own work and ignore the noise. Suffice it to say, we're not biting on this recent rally because our work and process is so convincingly bearish on earnings. Importantly, our call on earnings is not predicated on the timing of a recession or even if one occurs this year. Our work continues to show further erosion with the gap between our model and the forward estimates as wide as it's ever been. Could our model be wrong? Of course, but given its track record, we don't think it will be wrong directionally, particularly given the collection of leading series and models we published that point to a similar outcome. This is simply a matter of timing and magnitude, and we think the timing is imminent. We find the shift in investor tone helpful for our call for new lows in the S&P 500, which will finish this bear market later this quarter or early in the second quarter. Getting more specific, our forecasts are predicated on margin disappointment, and the evidence in that regard is increasing. When costs are growing faster than sales, margins erode. This is very typical during any unexpected revenue slowdown. Recessions in particular lead to significant negative operating leverage for that very reason. In other words, sales fall off quickly and unexpectedly while costs remain sticky in the short term. Inventory bloating, less productive headcount, and other issues are the primary culprits. This is exactly what is happening in many industries already, and this is without a recession. It's also right in line with our forecast and the thesis that companies would regret adding costs so aggressively a year ago when sales and demand were running so far above trend. Bottom line, after a very challenging 2022, many investors are still bearish fundamentally, but are questioning whether negative fundamentals have already been priced into stocks. Our view has not changed as we expect the path in earnings in the U.S. to disappoint the consensus expectations and current valuations. In fact, we welcome the change in sentiment and positioning over the past few weeks as a necessary development for the last stage of this bear market to play out.
Mike Wilson points out that yes, we have had a move up in equity prices in January. However, we had at least 3 such moves in 2022. What happened there? The market allowed those short-term rises in stocks and then sold off and moved on down. It happened every time in 2022. He points out that reduced earnings and margin contraction will lead to further decline in stocks. I won't repeat his points. He stated them well. You might want to go back and listen to either or both of these videos. There is a reason he was voted the #1 market strategist by his peers in 2022. He tends to be right on the direction of the market. Keep in mind that he does not have a negative bias. He is just responding to what the data says. I think it is interesting that the rally was, as he points out, was mostly led by low-quality stocks and heavily shorted stocks. Isn't that interesting? What that means is the heavily shorted stocks, they were covering those shorts. And the low-quality stocks, there are enough of them that was able to push the market up. They were not what is considered high-quality stocks. In other words, that does not signal that large institutions, including Morgan Stanley, are buying yet. The positive side of this, which he also mentions, is that he expects the market to rally in the second half of 2023. In other words, get ready to make some money, but not yet. Be careful not to confuse the economy with the stock market. They can often go in different directions. Again, I think that traditional financial advisors will get it wrong. They will again stay invested through another decline. Next, Becky Quick from CNBC interviews Dr. Mohamed El-Erian, and Dr. El-Erian points out both sides of market conditions. Yes, there are reasons to be optimistic, and he lists those reasons. However, he is still cautious because we're still in a bear market. Earnings contraction and the Fed's fight with inflation are still ahead of us. If we're in a long-term secular bear market, which I think we are, then we will experience short-term growth spurts in the market as well as market declines. But the long-term direction for many years will be down. That is, if we're in a bear market. And I don't know how you can interpret 2022 other than saying we're in the beginning of a long-term secular bear market, inside of which will be short-term cyclical bulls and bears. That's how all secular markets have worked for the last 150 years. Regardless of short-term market moves, be aware of the longer-term trend. Take a listen to Dr. El-Erian.
So far, the year is young, 23 days in, but you are talking about some pretty phenomenal rallies that you've seen in stocks and bonds to this point. You think that trend continues?
You are for 3 reasons, and you heard it. 1 is economic prospects have improved. 2 is the market feels inflation is mostly behind us, the problem. And 3, the Fed has signaled that it's going to downshift to 25 basis points. And not only have we done well domestically, we've done even better internationally with 2 big trades from the US to the rest of the world and into bonds. I look forward and I see many potential outcomes for this year. The one that Joe cited a few minutes ago is certainly a possibility, not a probability. but there's also others. So I think the year we're going to romance different outcomes with respect to growth, inflation, and the Fed.
Okay. Larry Summers was a little more sanguine about the environment, what the Fed's going to have to do. But he did make the point last week that the one thing we have to make certain is that inflation is really dead and it doesn't come back to haunt us, so that we don't have to fight this fight twice. I would assume you're kind of in the same camp on that.
I am. And the inflation dynamics themselves are not very encouraging, because what has happened is inflation has moved from the goods sector to the services sector. And that's much harder to contain. So I'm in the very, very small camp who thinks that they should not downshift to 25 basis points. They should do 50. They should take advantage of this growth window we're in. They should take advantage of where the market is, and they should try to tighten financial conditions, because I do think that we still have an inflation issue.
Okay, now I want to shift gears, and this is on credit. I saw this article, it was a Bloomberg article. More Americans are falling behind on car payments than during the 2008 financial crisis. So there is more debt, more short-term consumer debt related to, it could be cars, it could be credit cards, that sort of thing. And there's more of that than there has been in the past. And it is going up and up. Why? I think a lot of it has to do with inflation. Most people are working. If people want a job, they can work. But inflation is not keeping up, or wages, real wages are not keeping up with inflation. So people are falling further and further behind. And groceries has a lot to do with that. But anyway, I think this is showing up in this information here, that more Americans are falling behind on car payments. Now I want to show you some data. This is the rise, and this goes back to 1994. So this is the rise in delinquencies on car loans. Now, there are other forms of consumer debt, like credit cards, for example, or bank loans. But this is an indication of the how consumers, the American consumer, is being squeezed, and beyond their savings and having to go into debt, probably to just exist. And I think most people don't want the debt, but I would say, here's my comment. I think that if you have debt, short-term debt, you can think about, I don't want to give you advice, but think about what are the ways, is that's a concern to you? What are the ways that you can reduce that debt, or that you can eliminate that debt, both from additional income as well as from cutting expenses? Sometimes people are doing everything they can. They're doing the best that they can. But think outside the box. Is the way that you can become more financially solvent and more liquid and have less leverage, like debt. This is now I want to go into the employment rate. Unemployment is still at 3.5%. That's a very low number. But the economists that I'm reading are saying more and more that it is going to move up to 4%, 4.5%, maybe even 5%. That's not crisis territory, but I think unemployment is not going to stay at 3.5%. This shows the number of states that have had a rise in the unemployment rate. So it's kind of a trend chart, and you can see it goes up and down. But at the top, 50, okay, there are 50 states. Where we are right now, I put an arrow on here, where we are right now is we're at 39 of the 50 states are showing a rise in unemployment, even though overall we're still sticking at about a 3.5%, very low unemployment rate. Housing investment as a contribution to GDP growth. So you can see, this is a quarter by quarter for the last several years, you can see that to the right of the chart, you can see that the housing is a negative contribution to GDP. In other words, housing prices are beginning to fall and have been falling for a while. This chart shows that a rapid tightening in financial conditions is recessionary. There are two charts here. One is the real GDP year over year, the black line. The brown line is the estimate from Goldman Sachs that shows that when financial conditions like the Fed is selling assets off their balance sheet and raising rates, when that is called tightening. So when the Fed is doing something like that, tightening financial conditions, that it spells generally a coming recession. And you can see the degree, at least from Goldman Sachs' standpoint, where they believe we are in that cycle. The other thing that's been happening for several months now, I think it started last September, was that the Fed, well, I think it started before that, but then the Fed ramped up their tightening so that they were selling 95 billion, this was in September, 95 billion of assets, mortgage-backed securities and treasuries off of their balance sheet in order to create liquidity. And that started, I believe, in June, and at half that rate at 47 billion, and then in September up to 95 billion. At this point, they have removed about 500 billion, about $500 billion off of their balance sheet. What that does, though, is it sucks money out of the economy. So you've got $500 billion being pulled out of the economy because the Fed is cleaning up its balance sheet. That's appropriate that they do that, but it is damaging to the economy when all of a sudden, this is a chart showing M2. M2 is a money supply, and the Fed tracks that out of the St. Louis office. So you can see what happened as a result of the selling off of assets. All of a sudden, the money supply, M2, has been reduced substantially. This is not a positive contributing factor to the for economic growth. This is the flow of funds report. There were outflows in equity funds of 1.4 billion during the past week. The inflows in bonds and in bond funds was 4.3 billion, and money market funds had inflows of 16.1 billion. Doesn't really tell me that that's not a growth picture. It's interesting that it's kind of a defensive picture, even though equity funds have gone up, and that matches with Mike Wilson's comment that the rise has been mostly in short covering and in low quality stocks. I saw this article. This is kind of interesting. So it's a little bit of an aside, but it does relate to the economy. I saw this article and it said, large fire at Connecticut egg farm. Well, I've covered this before, of fires and explosions and the extermination of farm animals, chickens, turkeys, pigs, cattle, ducks, whatever. So I saw this and I read the article, and there were, this was last week, 100,000 chickens were burned or suffocated because of the fire at this farm. 100,000. Here, I want to play this. Here's a clip from their local TV station. It's 30 seconds. You can just see what they said about it.
And we are also learning a massive fire at an egg farm in Basra left as many as 100,000 chickens dead. This happened early this afternoon at a Hillendale egg farm on Schwartz Road. It quickly turned into a 3-alarm fire with as many as 20 companies responding. The Salvation Army on the scene confirmed with firefighters 100,000 chickens sadly perished, but no other injuries have been reported.
This is some data that I covered a few months ago. This showed up in the article. This is 34. This list is not 34 long. It is 97 long. So think of this as about 1/3 of the entire list. If I showed you all 97, they would look just like this. And these are fires, explosions, or where the government has ordered the destruction of chickens, or in some cases, cows, pigs, turkeys, ducks, animals. And we rely on those, and of course we rely on chickens for both the meat from the chicken as well as the eggs. And of course the price of eggs has gone up from about $3 a dozen to $6 a dozen in the last year. And as their inflation rate is softening, egg prices are not coming down. They're staying stubbornly at about $6 a dozen. Why is that? Now, when you look at this data, this goes back for 2 years. This is 2 years of fires and explosions and destruction of animals. Why? And each one of these has a link, and it cites the number of animals that were destroyed. And when I didn't go through and add it up, it's just kind of a long process, but it was about 20 million. I'm just guessing, something like that. Some cases there were millions here. Some cases there were hundreds of thousands. But the whole thing was, I'm saying, at least 20 million that had been destroyed. So if you're seeing the price of eggs go up, how does it not go up? And I got to tell you, and I look at all this, I'm not a conspiracy theorist. I don't want to promote conspiracy theories, but it is just really suspicious to me that these started about January of 2021. And for 2 years, about 20 million animals were destroyed. Does that seem it just doesn't seem coincidental. So I'll just leave it at that. That's it. Inflation is officially out of control. Thank you for watching. If you have comments or questions, leave them in the comment section below. I will try to answer your questions. Thank you for watching.